Alright guys, Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasiryamin and I welcome you all in this session. Now guys, this is a very important session by all means. Why is this an important session? Because in this particular session, we are going to be attempting a very recent past paper from June 2024 attempt, and this is going to be all about foreign subsidiaries. You guys know that under today's SBR format, the consolidation question comes into a pre-populated, sheet format. And it's often seen that students get confused on how to solve questions in this particular format. And this particular question will give you a very good idea on how to do that. So overall, it's a very good question. I would like to, seek your support throughout. Just make sure that you stay attentive and we'll do it, inshallah, very quickly. So let's begin. It says that Peony company is the parent company of a group with one overseas subsidiary and a financial year end of 31st December 20x2. Now, if I were you in the exam and I had seen the word overseas subsidiary, first thing that would have come into my mind would have been the learnings, would have been the chapter of foreign subsidiaries. You guys do remember how we started off foreign subsidiaries, right? First of all, we studied about IAS 21. In the initial phase of IAS 21, I explained you that what do you mean by a functional currency, and a functional currency is generally a local currency, but not necessarily. And what is a presentation currency? So we discussed that functional currency is the currency of primary economic environment. And if you want to assess what's the functional currency of your primary economic environment, you had to ask some simple questions. And these questions were split into two categories. The first category was primary factors. And I want you to recall those factors while you listen to me. You need to recall them in your mind. There were some primary factors. In what currency is your sales price managed? How do you manage your material labor overhead cost? What is the currency of your competition? These were the primary factors. And if you weren't able to conclude what is your primary economic environment currency, what is your functional currency based on primary factors, then you are allowed to go towards secondary factors that were, those were more entity specific. Where do you get your operating proceeds from, and where the finance is being generated, right? So your operating activities and financing activities tell you what is your functional currency, because that type of currency supports your existence. Furthermore, as we moved on to accounting for, a foreign subsidiary, first of all, we discussed the distinction between what can be termed as an extension of parent and what can be termed as a net investment in an overseas entity. You see, it is quite possible for a company to have, their foreign existence. But not every foreign existence can be termed as a foreign subsidiary. Not every foreign existence will be exposed to the requirements of IAS 21. There can be a case where a parent company has a sales office or a branch office or a retail store outside their own country. So they are in a foreign country, but the retail outlet or the branch office or the sales office is directly run based on the instructions of the parent company. Now, if that is the case, we call this scenario that this is an extension of parent company in a foreign country. And when that's the case, remember that the foreign entity's functional currency would be the same as the functional currency of parent company. And therefore, there is no case of foreign subsidiary consolidation. Make sense? However, there can be another case in which you can call a net investment in an overseas entity. Why do we call it a net investment? Because that type of investment tells you that you have a stake in a foreign autonomous entity, and you don't have a stake to control daily activities or all significant matters. You exercise your control through the investment that you have made in their net assets. You exercise your control over equity to direct the relevant activities of the business, but not every action is defined by you. So in this case, we determine that the foreign entity is rather autonomous. Now, how do you decide on a particular scenario if it's an extension of a parent or if it's a net investment in foreign entity? You decide based on some additional factors. Does anyone of you remember what were those additional factors? At least tell me one. At least tell me one, and then I'll carry forward. At least tell me one. What were the additional factors that an entity had to consider, in particular a parent company had to consider, to in order to decide if the investment that we have made in a foreign country is an extension of parent or a net investment? Yes, you consider degree of autonomy, you consider number of transactions between these two parties, you consider where the operating proceeds are retained. Are they retained by the subsidiary, the foreign entity themselves, or are they directly remitted to the parent company in the original country? And you need to decide if S company or the foreign entity is dependent upon the parent to satisfy their debt obligations. Do you need to justify on that parameter? Now, if you decide that the S company in the foreign country is not autonomous, then it's an extension of parent. Then there are no further discussions about IS 21's implication. But if that's not the case, it's an autonomous entity. Then you determine the functional currency of that entity based on the primary and secondary factors we discussed earlier. All good? All good? Is this okay? Just let me know if this revision was good enough for you guys. Make sense? Make sense? And there was something, furthermore as well, right? So if you decided that there is a foreign subsidiary which has a functional currency other than that of the functional currency of parent company, then there is the case of foreign subsidiary consolidation. So the steps of foreign subsidiary consolidation were very simple, and there were 3 steps. You adjust and update, you translate, and you consolidate. Adjust and update means that first of all, you will need to make any possible adjustments that are there for a particular subsidiary into their own functional currency. First of all, you adjust and update the financial statements of foreign subsidiary according to the requirements of consolidation. Once you have done that, you translate. And for that to happen, there were some translation rules that we'll be discussing, that we'll be revising, now as well. And then you consolidate based on the normal consolidation rules. What were the translation rules, by the way? Do you guys remember what were the translation rules? The translation rules were very simple. Any number, any balance that pertains to the acquisition date, you use the exchange rate based on the acquisition date. So basically, you take the acquisition date rate to translation the balances on the acquisition date. Any transaction that happens during the year, either you opt for the actual rate of that particular transaction, or in the absence of the actual rate, for the sake of simplicity, you opt for an average annual rate to translate the numbers of the foreign subsidiary. And for closing date balances, you always choose the closing date exchange rate to translate the values. Make sense? You always had to prepare 2 types of workings. One working was exchange gain or loss on goodwill, and the other working was exchange gain or loss on net assets. Make sense? Make sense? Is everybody on the same page with me? Just let me know, is everybody on the same page? Clear for everyone? Give me a yes. If that's so, we can, make sure that we read this question thoroughly and solve it as efficient as possible. All right. So now we know this is a foreign subsidiary question, and the financial year end of this question is 31st December 20x2. It says that the functional currency of Peony company and the presentation of Peony company group is the dollars. So first of all, we've made it clear that Peony company is the parent company of an overseas subsidiary, and the functional currency of Peony company is the dollar. Make sense? Now, examiner says that the following exhibits available on the left-hand side of the screen provide information which is relevant to the question. Now, there are 4 exhibits provided to you. The first exhibit is about the functional currency. This provides information used to determine the functional currency of Nomstra, an overseas subsidiary. So now you know that there is another entity whose name is Nomstra. It's an overseas subsidiary. And by reading the first exhibit, you will determine the functional currency of Normstra. You will determine the functional currency of Normstra. All right. Then there are some three issues. This exhibit will describe three issues relating to the acquisition of Normstra company and overseas subsidiary. Then there is third exhibit, which is about changes in government regulations, which describes the changes in government regulations in the country in which Normstra company operates. So there is something changing in the political or legal framework of that country, and that change needs to be accommodated into your answer. We'll see how that is to be done. And then you have fourth exhibit, which provides you a draft consolidated SOFP for the Peony group. Remember, a draft consolidated SOFP has already been prepared. So most of the consolidation requirements would already have been done. And just for the sake of familiarity, if we open this exhibit number 4 and see, you see, we have a consolidated SOFP already prepared, but this is draft. Draft means it's not final. Now we see that we have been provided with group property, plant and equipment. Goodwill has already been calculated. Current assets are there. Total assets are there. Parent company's equity is there. Consolidated retained earning is there. Consolidated retained earning is there. So that's already been done. Then there is translation reserve, other components of equity. We heard about translation reserve earlier as well during our lectures on foreign subsidiary. It seems that translation reserve has already been calculated by the examiners, so we must be responsible for doing something else. So the translation, exchange gain or losses that primarily arose on the working of goodwill or on the working of net assets, some way or the other, these have been calculated and accommodated by the examiner. Then there is NCI, then there are liabilities, and then there are total group equities and liabilities of 22425. Makes sense? So at least some part of it, examiner has already done. Now, before we even move further, I would not like you to open up the exhibits right now. That's not the right way to solve questions. What I would suggest is that you go step by step. You open the requirement. First of all, you see what's the first requirement, and that says that using exhibit 1. Remember, the first requirement, which is of 5 marks, only pertains to exhibit number 1, right? So using exhibit number 1 and in accordance with IAS 21, explain why Normstra's functional currency is the NAI. So examiner is asking you why. Why would you conclude that Normstra's functional currency is not the dollar, but it's NAI? It should have been YY, but it is right now NY. All right. So I would need your help, right? The purpose of solving this question into this session is not just that I talk and I solve this question. I want your participation. That's the most valuable thing that you can give me right now. Okay. So now we have a question in front of us, the exhibit number 1. Let me zoom in a bit so that you guys, all of you guys can see. And I hope it's visible. So it says that Normstra company is a foreign subsidiary of Peony company with a functional currency of NAI. So they determined that Normstra has a functional currency of NAI. Now I ask you a question, everyone. Can functional currency of a subsidiary be determined right away using primary or secondary factors? I mean, that is how they would have determined that the functional currency is NAI. But can you use the primary and secondary factors of determining functional currency of a subsidiary right away? Is that allowed? Give me a yes or a no. Is that allowed? What is the first step you follow whenever you see that an investment has been made in a foreign entity? What do you do? What do you do? The first step, guys, that you follow is to determine if the overseas entity is merely an extension of parent. It's just an investment vehicle to operate in a foreign country, or if it's a separate autonomous entity on which you have control through the control over their equity, that is net assets, a net investment in a foreign operation, right? So we need to determine that. So it says that Nomstra company sales and related costs are predominantly denominated and settled in NI. Peony company, by the way, if you read this, by the way, Nomstra company sales and related costs are predominantly denominated and settled in NI. Can anybody tell me what does this line indicate? In what area of IS 21 will this particular line help? Can any one of you tell me? What area does this pertain to? What area does this pertain to? Sales and related cost. And yes, these are primary factors. And somebody just wrote, sir, primary factors are being met. You see, this is the point that I want to make. And that's why I'm taking my own time. A person could have done this question totally wrong just by focusing on the fact. You see, examiner asks you why NI is the functional currency. So that they have already told you the answer. NI is the functional currency. They are just asking you why. And if anyone was to answer because their sales and related costs are predominantly, predominantly denominated in NI, if you would have said this reason, you could have lost 5 valuable marks. Because the point is that you cannot jump to primary factors straight away. You need to make a distinction if this is an extension of parent or this is a foreign subsidiary. And that is why you need to read the question, questions scenario all along. It says that Peony company had previously provided a supporting loan in dollars to Nomstra company. So the parent company provided finance to the overseas subsidiary through a supporting loan. Just focus on this fact. This is a supporting loan. Now, when do you ask for supporting loans? When you are in trouble. So most likely the overseas subsidiary was not in a position to manage its financial position or its operations, and that is why they would have asked for a supporting loan from their parent company. Doesn't that seem that the overseas entity is relied upon the parent company whose functional currency is the dollar? At first, it would seem like this. But it says that which had been settled during the year and funds from financial activities are currently generated in NI. So there is a mix. First of all, your examiner tried to tell you that you are financially dependent on your parent company. But that same point was negated in the next line. Your examiner said that NI was able to generate enough cash, enough operating cash that they were able to pay off the supporting loan that they took from their parent company. And right now, all finances, whether it be equity or debt, all finances are being generated in NI. It says that Nomstra company's board of directors is free to determine its decisions independently from the board of Peony company. What do you say? Based on the additional factors, do you see that Nomstra is an autonomous entity, yes or no, or if it's an extension of parent? What do you guys say? What would you guys say? The first part of your answer should be that it is an overseas subsidiary because they have the authority to make their own decisions. They settle their, they settle their transactions in NI. They have paid off the supporting loan, so they are not financially dependent on the parent company. So, all of this suggests that Nomstra is an autonomous entity and therefore its functional currency should be determined based on primary factors. Or if not concluded based on primary factors, then you should jump onto secondary factors. And I'm very sure you must have determined the other part of the answer right now is that based on primary factors, since sales and related costs are predominantly denominated in NI, it's very easy to determine that based on primary factors, the functional currency of Nomstra company has been correctly calculated as NI. Does everybody agree to this? Does everybody agree to this? I want two answers from you. Do you agree with whatever we have discussed? Number one. Number two, would you be able to write a 5-mark answer where your examiner wants a justification as to explain why Nomstra company's functional currency is 9? Can every one of you guys, can the whole class answer based on the knowledge that you have? Let me know. Yeah. So at least the first 5 marks in June 2024 attempt were not too difficult, and everybody should have made the correct answer and gained those 5 marks. Make sense? Now, like always, what I have done is I have wrote an answer in my own words for you guys, and I'll be providing you this answer for sure. Yeah. So what I have done is, you know my pattern of writing. So I always start, and this is the golden word that you start with, and that is according. So according to IAS 21, I explained what are the additional factors and that they need to be considered while before you even go and determine the functional currency of the overseas subsidiary. First of all, you need to determine if it's an extension of parent or or really an autonomous entity on which you have control through net assets. Then I define what are the additional factors. You should remember these additional factors. If in an examination scenario you are unable to remember all those 4 factors, at least the crux of those 4 factors, you can write it down. There is no requirement in an exam that you should write exactly all the text of International Accounting Standard or International Financial Reporting Standard as it is. It's not an open book exam. So nobody expects you to write the requirements as it is, but whatever you remember, you can write it in your own words, and that would be acceptable. And then we go on to say that in this case, the board of directors of Peony company run independent decisions. Though Peony company was dependent on Normstra for a supporting loan. Again, you need to mention this point very clearly, guys. You need to mention this point very clearly. You see, at one stage we thought that since they are seeking a supporting loan, they might be financially dependent on the parent company, and that would seem to suggest that it is an extension of parent. But on the other hand, this point was negated. So you see, whenever you are explaining to your examiner what is the rationale behind your answer, you need to write with completeness. So what I have done in order to ensure that every aspect of the scenario has been covered into my answer, I said that though Peony company was dependent on Normstra for a supporting loan, however means you are negating the earlier thought. So, however, now the loan has been settled through funds generated from operations of Peony company. Hence, there is enough evidence to justify that Peony company is an autonomous foreign operation, and therefore the functional currency should be determined using primary or secondary factors. And then I explain all the factors and so on and so forth, right? So, I'll be providing you this answer, which I wrote it myself. And I'm very sure that you will be able to make an answer which is even better than mine. But please make sure that you write an answer for yourself. It's very essential that you write an answer for yourself. Okay. Do not miss it out. All right. So I guess let's move forward. Now we are on the B part. And in the B part, your examiner says that with regards to 3 issues outlined in Exhibit 2. So basically, there are 2 sub requirements of 10 marks each. And guys, as you see the question, it is evident that these 20 marks come from the exhibit number 2 themselves, right? So whatever 20 marks we need to obtain through the exhibit number 2. That is the main exhibit of the question. So in part 1, they say that discuss with calculations how to correct the treatment of Nomstra company in the consolidated financial statements of Peony Group for the year ended 31st December 20x2. So the first requirement is about discussing and calculating and providing relevant calculations on how to correct the treatment of Nomstra company. This is the first part. And in the second part, you are provided with 10 marks. These are very easy and on the plate marks. You are provided with 10 marks just to adjust the pre-populated response option sheet to correct the draft consolidated SOFP of the Peony Group as at 31st December 20x2. If I were your examiner, I would certainly say that these are free marks to you. Completely not acceptable. If I were if I was in your place, I would go and tell to my examiner, this is completely unfair. You are giving me 10 marks just to make an adjustment in the draft consolidated SOFP. Why are you giving me so much marks so easily? And I would say, I won't take it. Most of the students might have done that. They would have said, we are not going to take it. We are going to come in next attempt and then solve the same question again. Huh? Let us not make that mistake. Yeah, so you do 10 marks just to adjust the consolidated SOFP. For sure, these are bonus marks. All right. So now we know that the most important aspect is to discuss with calculations about the correct treatments regarding Exhibit 2. And then we need to adjust the pre-populated response sheet, right? So let us see what does Exhibit number 2 actually have, right? And you see, what I'll be doing is I'll be opening the spreadsheet response option at the same time. Why am I doing that? Because I know in the B part, I need to make two things. First of all, I need to do some workings. For that, I'll be using the spreadsheet response option. Next, I need to adjust for the second part. I need to adjust the pre-populated sheet. And that is why I have opened the spreadsheet response option. I'll be doing the workings simultaneously. Okay. So let us read. It says that on 1st January 20x2, mind you, 1st January x2 means the start of the year. Peony acquired 75% of the 1.5 million NI1 ordinary shares of Nomstra company for $1.1 million. So basically, Peony company has acquired 75% holding in an overseas subsidiary. And how much capital, how much equity capital does Nomstra has on that date? They have issued 1.5 million shares with a par value of NI1. And that means the share capital would have been $1.5 million or 1,500 if you were to talk in thousands, right? And we have acquired this stake for $1.1 million. Dollars is our functional currency, the functional currency of the group. It says when the retained earnings of Nomstra company were nigh 4.8 million. What is this retained earnings of 4.8 million? What is this? Can anybody tell? What does this 4.8 million represent? What does this 4.8 million represent, guys? Can anybody tell me what is this 4.8 million? It seems that this is the retained earning that was available with overseas subsidiary at the acquisition date. So this is basically pre-acquisition retained earning. Excellent. Very good. It says there were no other components of equity. Very good. Peony company determined that the non-controlling interest NCI in Nomstra company had a fair value of 2.7 million NI at the acquisition date. So they are also providing us with fair value of NCI at the date of acquisition. Now, can anybody tell me why would they be providing us with pre-acquisition retained earnings and NCI's fair value at the date of acquisition? Very good. This would help us in determining the value of goodwill. Then they say that during the year ended 31st December 20x2, which is the first year, Nomstra company reported a loss of 900,000 NI. So they have reported a loss this year. We acquire them, they make a loss. They say that no dividends were paid or proposed. Very good. On 31st December 20x2, Nomstra company's total equity was 5.4 million. Now, I have got a very tough question for you. It's not that tough, actually. Their total equity at balance sheet date, they say it is 5.4 million or 5,400. Can you tell me what would be the amount of their retained earning? Do you see, this is total equity. Total equity means share capital plus all reserves. Yeah, this is share capital plus all reserves. Can you tell me what would be their retained earnings at that date? What would be their retained earnings at the balance sheet date? Can anybody tell? I mean, it's very easy to answer. 4.8 million less 900,000, one way. Or the other way is that you know what was the amount of share capital, right? So share capital was 1500. Remember? So the retained earning at balance sheet date would have been 5400 minus 1500. That comes up to be 3900. And the difference between 3900 and the retained earnings at the acquisition date, which was, how much was it? It was 4800. This is a difference of 900, which is the post acquisition loss for the year. Everybody understood? Make sense? Is this clear to everyone? Let me know if this is clear to everyone. Yeah? Is it clear to everyone? So why am I explaining this to you in between? Because this is how you approach a question. You cannot approach a question just by, reading the exhibit very quickly and then expect yourself to answer very well. That won't happen. So always make sure that you start to, you start to open up the question as much as possible while you're reading it. Okay. Then examiner has provided you some exchange rates. Exchange rate at the date of acquisition, which is 1st January X2, was 912 per $1. Then there is 31st December 20X2 rate, which is the closing date exchange rate, which is 918 to $1. And then there is a weighted average rate for the year ended 31st December 20X2, which is 915 to $1. All right. So we have been provided with exchange rates as well. Now, examiner has provided to you some three issues, all right? And we'll read these three issues and try to solve them. The first issue is goodwill arising on the acquisition of Nomstra company was calculated incorrectly. Oh my God. Please note this down. Goodwill arising on the acquisition of Nomstra company was calculated incorrectly as 725,000. If you see in the below exhibit, a 725,000 goodwill has been calculated and the working has been shown, but the examiner is already saying this has been calculated incorrectly. There is some error in this. This says this is also the amount included in the draft consolidated SOFP. So the same has been included in the balance sheet. It says that in arriving at this figure, the NCI at acquisition was translated and recognized using the exchange rate at 31st December 20X2. So what they are basically saying is that, they did some calculation. They took the consideration correct. Then when it was the fair value of NCI at acquisition, they divided it, in order to translate it into the local currency for the purpose of consolidation. They translated this fair value of NCI at acquisition based on the closing date exchange rate rather than dash. What exchange rate should they have used? Can anybody tell me? What exchange rate should they have used? Very good. For acquisition date transactions, you always choose the acquisition date exchange rate. So they were incorrect. What they did was they chose the wrong exchange rate. And for that reason, your NCI of $150 would have been calculated wrongly. Make sense? And eventually your goodwill would have been calculated wrongly. And then they took fair value of identifiable net assets as 6.3 million. Can anybody tell me how this 6.3 million NAI has been calculated? I will give you a reward if you tell me how this 6.3 million NAI has been calculated. It's very easy. I just want your brain to work. This won't This is how I get to know that you'll be able to do the same while you are doing the question by yourself. Where did this 6.3 million come from? No, it's very easy now. Let's go back to the question. You see, we determined that the share capital was $1.5 million or 1.5 million NI, and then the retained earning at the acquisition date was 4.8 million. So 4.8 million plus 1.5 million is 6.3 million. So simply putting share capital plus the pre-acquisition retained earning, that is 6.3 million. Make sense? Right? So they translated the 6.3 million based on the 12 NI exchange rate, which is correct, which is the acquisition date exchange rate. They calculated fair value of identifiable net assets correctly, and then they had a wrong goodwill due to wrong NCI. I'll read note number 2 as well, and then we will start with our first working. We will start with our first working. At 31st December 20x2, which is the year end, a goodwill impairment of 3.3 million was calculated, but not recognized in relation to Nomstra company. Very good. What have they done? What have they done? They calculated impairment, but did not account for impairment. You see, impairment is a loss, na? Impairment is a loss. So, CR, NCI, debit, goodwill, credit, this is what happens. But although they had calculated impairment, they had not accounted for impairment. They are saying that the group policy is to translate goodwill impairments at an average rate of exchange. So this is their accounting policy. Make sense? Now, I would not read the third issue right now. I'll tell you why. Because I feel that once you have talked about impairment, there is enough data available just to make sure that you can start the working for goodwill. You see, I told you whenever there is the case of an overseas subsidiary, there are at least two workings that you always need to do. Can anybody remind me what were the two workings that we always had to do while we were translating an overseas subsidiary? What were the two workings? Guys, let me know. Come on. What were the two workings that we used to do? Number one was, exchange gain or loss on goodwill. Make sense? Yeah. Number one working was exchange gain or loss on goodwill. And the other working was exchange gain or loss on net assets. Remember? So we'll start with our first working, which is exchange gain or loss on goodwill. Guys, when we are working on exchange gain or loss on goodwill, we will make three columns essentially. I always told you, make a column for foreign currency, make a column for exchange rate, make a column for local currency. Remember? And then what was the format of determining goodwill? Yeah. So you start with your consideration. Yeah. You start with your consideration, add fair value of NCI at the date of acquisition. Yeah. Then you subtract fair value of net assets of S company at acquisition. Yeah. And once you have done that, you get goodwill. Make sense? Now, up till now, always remember that while you are calculating goodwill at the date of acquisition, remember this is goodwill at acquisition. So while you are calculating goodwill at acquisition, remember the only exchange rate relevant to you is the exchange rate at the date of acquisition. And if you go and see, we made the acquisition on 1st January X2, and at that date, the exchange rate was 912. Yeah. So 12, 12, 12, 12. Yeah. So for everywhere, the exchange rate is 12. Make sense? And once you have calculated goodwill at the date of acquisition, remember I read the point number 2 as well. I know for sure that there has been an impairment, impairment during the year. So I account for that impairment during the year as well. And then I am left with goodwill at balance sheet date. Make sense? All right. So remember, there were 3 steps to consolidating a foreign subsidiary. The first step was to adjust and update. I always used to tell you that first solve the whole question, solve the whole question into foreign currency, and then translate the foreign currency into local currency. So what I need to do is I need to solve this whole question in foreign currency first. I'll start with a consideration. Can anybody tell me what's the consideration that we paid to acquire S company? You see, you go and see the consideration that we paid is $1.1 million. Now, this consideration is not provided in NI, it has been provided in local currency, the dollars. Yeah. Now, I need this local currency to be converted into the foreign currency, which is NI. How do I convert it? Do I multiply or do I divide? Any idea? Do I multiply or do I divide? This is a common query, in everyone's mind. Do I multiply or divide? You see, it was written that $1 is equal to 12 NI. So isn't this pretty obvious that $1 is equal to 12 NI? So higher NIs are always equal to less dollars. So the dollar answer will always be less and the NI answer will always be more. So you'll have to multiply by 12 in order to get a higher answer. And that is how I solve it, with plain simplicity. Make sense? Then you need fair value of NCI at acquisition. We had been provided the fair value of NCI at acquisition as 2.7 and the identifiable net asset value of 6.3. Remember? So this was 27 and then there was 6,300. And how do you calculate goodwill? You calculate goodwill at acquisition of 9,600. Make sense? Done? And then you had some impairment, right? So let us go and check for impairment. The goodwill impairment that was provided to us in point number 2 was 3.3 million. So 3.3 million is the impairment that happened during the year. If you subtract that as well, the goodwill calculated at the balance sheet date in the foreign currency is 6,300. Make sense? Done? Is everybody clear on this? Please let me know. Is everybody clear on this? Is everybody clear on this? Can I move forward? Yeah. So once you have solved the question into foreign currency, then you translate that into local currency. That's the step you follow. And for that to happen, you need relevant exchange rates. Now, in order to calculate local currency, that is dollars for me, I would need to divide 2,700 divided by 12, 6,300 divided by 12, 9,600 divided by 12. I'm left with $800 worth of goodwill. I'm left with $800 worth of goodwill. Now, I also need to translate the impairment. Can anybody tell me what exchange rate should I be using in order to translate impairment? What exchange rate? You are provided with 3 exchange rates, 12, 18, and 15. What exchange rate do I use? The average rate as per company's policy. Yeah. So that is 15. That is 15. And how do I translate the last value, the goodwill at the balance sheet date? How do I do that? Do I use the average rate still? For all closing date balances, you always use the closing date exchange rate, and that would be 18. Make sense? This was the 31st December rate, 18. All right. So now you start translating. And when you do this translation, you see that your answer does not match. $800 was the goodwill before impairment. The impairment's value is 220. And if you net off 800 into 220, I guess you are left with, I don't know, maybe 580 or something. But the answer that you have, goodwill at balance sheet date, is only 350. What is the difference between our answer and our working calculated? What's the difference? This is exchange loss, which is always calculated as a balancing figure. Do you all understand this? Yeah. This is exchange loss. How do we calculate it? Let us calculate the balancing figure. This is 230. Is it clear to everyone? This is exchange loss, which is calculated, not brought forward. This is calculated as a balancing figure, which is 230. Is everybody clear on this? I want a confirmation from everyone. Right? Now, our examiner said that there were 3 issues that they had to discuss with us. Now, at least we have solved first of the 2 issues. But sir, what was the actual issue? You see, your examiner had already prepared a draft consolidated SOFP, but they are saying themselves that that was not correct. Let us say, the examiner provided value for goodwill at the date of acquisition. If you see that into the question, that was 725. Yeah, that was 725. Let me write it down. The examiner calculated goodwill. The examiner calculated goodwill as 725. There was a clear-cut difference between their calculation and our calculation. Yeah, it was 75. Can anybody tell me why there was a difference between the goodwill at the acquisition date between our calculation and their calculation? What was the difference? What was the difference? Guys, the difference was they took NCI, they translated NCI based on the closing date exchange rate, which was 18, and they calculated NCI with a value of $150,000, whereas that should have been calculated as 225. So basically, the $75 difference that you see in the valuation of goodwill is basically the different valuation of NCI in dollars. Does everybody agree? Does everybody agree about this? The difference calculated in goodwill of $75,000 is only due to the less valuation of NCI, which examiner did. Examiner valued NCI at 150, whereas it should have been calculated at 225. Does everybody understand this? This is the first issue that we have answered. Is everybody on the same page? Yes? Can anybody tell me what should be the correcting entry for this? Can anybody tell me what should be the correcting entry for this? I'll write entries here. First entry is about NCI at acquisition. Can anybody tell me the correcting entry? You see, examiner calculated goodwill of 725. And you are calculating goodwill of 800. That means you are increasing goodwill. The correcting entry should increase the goodwill. So I would make an accounting entry, goodwill debit. Yeah, goodwill debit, 75. What should be credited? Can anybody tell me what should be credited? All of this difference arose due to the less valuation of NCI. And this less valuation of NCI would also have affected the final valuation of NCI, which would have been done at the balance sheet date. Agreed? You all know now, how do you calculate NCI for balance sheet? You start with fair value of NCI at acquisition. You always start with fair value of NCI at acquisition. And since you had calculated NCI at the date of acquisition 75 less, it would have diluted the balance sheet date value as well. So the correcting entry should be goodwill debit NCI credit 75. Is it okay for everyone? I want a yes. I cannot presume that you understand whatever I'm saying. So just give me a nod that everything's clear to you. I want that from everyone. Yeah. And then let's move on. What was the second issue that we faced? Do you guys remember what was the second issue that we faced? You see, examiner said that we had calculated impairment of 3,300. We had calculated impairment of 3,300. But we had not accounted for this impairment in our books. We had not accounted for this impairment in our books. Pretty clear. Now, and I can show this to you, just to be very clear. Examiner wrote at 31st December 20x2, a goodwill impairment of 3.3 million was calculated, but was not recognized in relation to norm stra. It was not recognized in relation to norm stra. Not recognized. If it was not recognized, then we need to recognize. Yeah. And if we need to recognize, we need to make this impairment entry. Can anybody tell how do I take impairment into account? How do I take impairment into account? What should be the accounting entry? What happens when you do impairment? Just start with the easy part of the accounting entry. Just start with the easy part. What happens when you do impairment of goodwill? What happens? Goodwill decreases. So at least the first part is goodwill credit. Goodwill credit 220. Yeah, makes sense. And what do you debit? Goodwill credit, but what do you debit? Is this full goodwill or proportionate goodwill? Is this full goodwill or proportionate goodwill? Can if anybody can answer? This is full goodwill method. You have used fair value of NCI at acquisition. This is full goodwill. And under the full goodwill method, you know that the logic is that goodwill belongs to the entire company and therefore goodwill belongs to each type of equity holder. So if goodwill belongs to each type of equity holder, the impairment loss will also be allocated to each type of equity holder. Hence, your accounting entry should have been consolidated retained earning debit, NCI debit, into their equal proportions. If anybody could tell me what were those proportions, I can do it myself. 220 into 75% and 220 into 25%. So CR NCI debit and goodwill credit should have been the accounting entry. Make sense? Is it clear to everyone? Done? Can anybody also tell me how to account for this exchange loss that arises on goodwill? What about this exchange loss that arises on goodwill? What should be the accounting entry for this exchange loss that arises on goodwill? Do you remember what we studied about this in our lecture? You see, any exchange gain or loss arising is to be recognized in OCI and transferred to translation reserve and accumulated under translation reserve and shared between CR and NCI both and shared between parent company and NCI both. Do you remember? And if it was the case of full goodwill method, the exchange loss arising on goodwill was also to be shared with NCI. Do you guys remember this? Do you guys remember this? Huh? So what should be the accounting entry, guys? There is an exchange loss of 230 on our goodwill. What's the first impact? The first impact is that your goodwill will reduce in dollars. Your goodwill will reduce in dollars due to this exchange loss. Do you guys agree? Make sense? Obviously, no? Your goodwill will decrease due to this exchange loss. Make sense? All right, I have done something wrong. You know what I have done? I've just tried to be smart. Oh God, yeah. It hanged for a second. So, okay. So, goodwill credit 230, your goodwill would decrease due to this exchange loss. And what do you debit? You debit translation reserve. We saw translation reserve in our SOFP's breakup as well, right? I can show it to you. See, there is a translation reserve or other components of equity already present. So we'll have to adjust this under translation reserve. So translation reserve debit and NCI, and NCI also debit. 230 into 0.25, 230 into 0.75. Is it clear to everyone? All good? Is it okay to everyone? We have just solved the two issues that were highlighted to us earlier. Okay to everyone? Done? Let's move forward. Let's read the exhibit number 3. It's exhibit number 2 and point number 3 rather. It says that Normstra company's assets and liabilities excluding the goodwill. What do you mean by Normstra company's assets and liabilities? What do you mean by this? Assets and liabilities. They're talking about your net assets. Yeah. So it's the second working that we studied under IS 21. Yeah. So Normstra company's net assets, excluding goodwill, were translated into dollars. Thank you very much. But using the exchange rate as at 31st December 20x2, that was the right decision to do. The same exchange rate was used to translate Normstra company's loss for the year ended 31st December 20x2. The resulting exchange loss of 175,000 has been included in the translation reserve in the draft consolidated SOFP with no entry made to NCI. With no entry made to NCI. Now, I see there are two issues here. First of all, they have used the same exchange rate to translate for the year loss as they used for the closing date net assets. This is wrong. For the loss, they should have used the average exchange rate. Somebody told very right. Yeah. And what's the other error that they have done? What's the other error that they have done? If anybody could tell me. What's the other error that they have done? They are saying the resulting exchange loss of 175,000 has been included in the translation reserve with no entry made in NCI. They haven't given any translation loss to NCI. Is that correct? NCI would always get 25%. Yeah, NCI will always get 25%. They haven't done that. So these are the errors that we see. Now, let us go and adjust these. All right. So working number 2 that we are doing is basically exchange gain or loss on net assets. You remember what were the columns that we had to prepare? These were columns of, foreign currency, exchange rate, local currency. The format was you take opening net assets, add or less in this case, it was loss for the year. So less, then you less dividends, and then you arrive on closing net assets. Make sense? Is it clear to everyone? So opening net assets, less loss for the year, less dividends, if any, and then we go for closing net assets. And I use the same format as I would have used earlier. You always start by solving the question in foreign currency first. Then you translate into local currency using the translation rules and the exchange rate. Make sense? So our opening net assets were 6,300 if you remember. Yeah, our opening net assets were 6,300. Then we made a loss for the year of 900. Remember, examiner said that there were no dividends paid during the year. Obviously, when you're making a loss, why would you be paying dividends? So your closing net assets would have been calculated as 5,400. That was already known. Now, the opening net assets should be translated according to the opening exchange rate, opening date exchange rate. What should be the exchange rate that should have been used to translate loss for the year? If you could tell me that. What should be the exchange rate that should have been used to translate the loss for the year? That should have been the average rate, right? So average rate, if you go into the question, the average rate was 15. Make sense? The average rate was 15. And the closing net assets should be valued on the closing date exchange rate, which is 80. So if we convert this into local currency, the calculations would have been as follows. Now you see that the dollar value of your opening net assets is 525. If you net off the loss for the year, it is supposed to be like I don't know, something 455 or something, 465. Yeah. But the ultimate answer that you see here in the closing net assets value, since they have been translated according to the closing date exchange rate, there is definitely a balance between the working. And that balance would certainly be an exchange loss. How do you calculate these? You take it as a balancing figure. Is everybody on the same page, guys? Please confirm. Make sense? So this should have been the calculation. You see, our exchange loss balancing figure that we have calculated while correctly working out all the particulars is 165. Whereas if you remember, the paragraph said that examiner has already done the working of exchange gain or loss on net assets, but they translated the Nomstra company's loss for the year based on the closing date exchange rate, and accordingly, they have calculated a loss of 175,000. They have calculated a loss of 175,000. If I can write examiner here, the loss that they have calculated is 175. However, it should have been 165. So is this correct? Is this correct? This is certainly not correct. This is certainly not correct. So what you need to do is you need to reduce this exchange loss. You need to reduce this exchange loss. Yeah. They have recognized a higher exchange loss of 175. We say that the exchange loss is only 165. You calculated 175 exchange loss because you used a wrong exchange rate to convert the loss for the year. We need to reduce the translation loss to correction of exchange loss. When we correct our exchange loss, can I say the translation reserve would increase by 10? The translation reserve would increase by 10. Make sense? And the corresponding adjustment should be done to CR and NCI. You know, basically why this happened. Please, look here. Look here. You see why this 10 difference arise? Because they calculated the loss in dollars not based on $15 exchange, 15 na exchange rate. They did 900 divided by 18. So according to them, the loss was 50. According to them, the loss for the year was 50. However, if it is calculated according to 15 exchange rate, the loss is 60. This 10 difference between the loss has been carried forward to the translation reserve. This 10 difference has been carried forward to the translation reserve. Do you understand? Do you understand? So the loss actually for the year in dollars is 60. It's not 50. So you need to increase your loss, and this loss will affect both parties, consolidated retained earnings and NCI both. 75% of this effect will go into CR and 25% of this effect will go into NCI. Let me know if it's clear for everyone. Is it clear for everyone? The difference in translation reserve that we saw is just due to the fact that they had calculated a wrong loss figure. They calculated a less loss figure, which should be corrected by reducing, the share of NCI and CR, and plus the translation reserve. That translation reserve needs to be corrected as well. Make sense? I want an answer from everyone. Does everybody understand this? Is it clear to everyone? All right. So now once we have made this $10 adjustment, our exchange loss is again 165 now. Please give me a yes. I want a quick yes. Once our loss has been corrected, our translation reserve again comes to 165 because we have made this correction. Yeah, we have made this correction. But there was another mistake that was there in the examination scenario. What was that mistake? What was that mistake? The examiner forgot to transfer any exchange loss to NCI. With regards to net assets, the examiner forgot to transfer any exchange loss to NCI. But we should give NCI's share of exchange loss. Now, how do you calculate NCI's share of exchange loss? Can anybody tell? There is the loss of 165, and at least 25% of it should have gone to NCI. That exchange loss has been parked under translation reserve. That should have been transferred to NCI. Can anybody tell me what should be the correcting entry, so that NCI gets the effect of loss and the parent company's reserves are compensated for this? What should be the correcting entry? And this is all common sense. Yeah. NCI did not get a share of loss. So when NCI gets a share of loss, will NCI reduce or increase? Obviously, when NCI gets a share of loss, it would decrease. So start with the easy thing, NCI debit. NCI debit 41.25. Yeah. And what should be credited? Our reserves will ease out because the loss has been transferred to NCI. Translation reserve credit 41.25. Make sense? Make sense? Is everybody clear on this? Is everybody clear on this? I want an answer from everyone. Done? So guys, now we have solved the entire 3 issues numerically. I know the discussion part is yet to be done, but at least the numerical part, the workings part have been done. It's done. All right. So now can we go and also prepare the pre-populated sheet? Yeah. So I've made these accounting entries, and now I know that 5 adjustments need to be made in the pre-populated SOFP. 5 adjustments need to be made. So let's talk about these 5 adjustments. The first adjustment is about NCI at the date of acquisition. I'll make some columns right now. This is NCI at acquisition, the first adjustment. Yeah. The next adjustment is going to be about impairment. I'm just going to write these down. Then there is exchange loss on goodwill. Then there is, a correction of exchange loss. So I can just write correction here. Maybe you can write the whole thing. That's up to you. Yeah. Correction of exchange loss. I'll just write it down. All right. And what's the full and final 5th adjustment? This is NCI's share of loss. So I can write NCI share. Make sense? And once we are done with this, we will get our final SOFP. Make sense? Now let us start posting. Let us post all these adjustments one by one. The first adjustment was to increase your goodwill and increase your NCI simultaneously. Increase your goodwill and increase your NCI. We'll start doing this. We will increase our goodwill. What my strategy on solving questions is, I always link it. So is equals to, go to the relevant cell by moving your cursor. Go to the relevant cell and just, make this adjustment. All right. Increase your NCI as well by the same amount. Then there is impairment. So goodwill is going to be reduced with a corresponding adjustment in CR and NCI. So goodwill is going to reduce. So it's a minus. It's a minus. Yeah. It's going to reduce by 220. And obviously it will also cause a minus in your consolidated retained earnings. 75% of the impairment goes to consolidated retained earnings. Some part of the impairment goes to NCI, 55. Make sense? Done. The third is exchange loss on goodwill. Again, your translation reserve and NCI will reduce and your goodwill will be credited. Due to this exchange loss, your goodwill's value will decrease. So it's a minus. You go with the negative sign. And then you reduce your translation reserve as well due to this exchange loss, and NCI as well due to this exchange loss. All done? Good to go, guys. The fourth adjustment is correction of exchange loss. The correction of exchange loss had an accounting entry of we increase our translation reserve but decrease our CR and NCI. So let us do that. We increase our translation reserve. So it's a positive number, 10. But we decrease our CR and NCI. So we decrease our CR by 7.5 and we decrease our NCI by 2.5. And the last adjustment that we have is NCI's share of exchange loss. NCI will get a loss and translation reserve will increase. We will start by increasing our translation reserve by 41.25 million. At the same time, decrease our NCI. Make sense? Is everybody on the same page with me? Just let me know if it's clear for you. Is it clear to everyone? Guys, is it clear to everyone? And once we have done that, why don't we sum up all the balances that we have? Yeah. We can just copy paste this whole thing. Doing this. Yep. Is everybody on the same page? Yeah. I'm just summing up all the relevant numbers here. This. There is total equity, summing up this. Then I'll sum up these individual balances of NCI. Then I have total equity of this number. Then there are no adjustments in non-current liabilities and current liabilities. Total liabilities come up to be 1,000 again. The total equity and total liabilities are 22050 with total assets of 22050. So the balance sheet exactly matches. Is this clear to everyone? Is this clear to everyone? I want some feedback. Come on, tell me. Is this clear to everyone? And now do you feel that, having 10 marks just to make these adjustments is a bit more it's a more of a very relaxed requirement to you. Isn't that easy? If if I were in your place and I would get 10 marks just to make plus or minuses, this is fabulous. Yeah, your concepts need to be very clear. If your concepts are clear, you are very well versed with the lectures. I don't think this kind of a question was a very difficult question. Surely anybody could score very well in such a type of question. All right. Now I would ask you one thing. Based on whatever we have discussed now, can you do a particular part which requires you to discuss? You see, I have done the calculations already on how to correct the treatment of Normstrom, but I want you to discuss this on your own. So most likely this is a 10-mark requirement. At least there will be 6 marks for a discussion. And discussion, what would you discuss? You will discuss whatever you have done in the calculations. So you will say that Normstar company calculated NCI based on closing date exchange rate. However, that was to be done based on acquisition date exchange rate. The implication of that will be that NCI would have been, diluted. It was incorrectly calculated as 150, whereas it should have been 225. The correcting accounting entry would be to debit goodwill and credit NCI, and so on and so forth. You will explain whatever you have done within the calculations. Can you guys do it? I seriously want an answer from your side. Can you guys do it? I want an answer from everyone. Otherwise, the other person is not doing it. Yeah. And I want you to do it. Guys, you be very serious about it. Just start to write answers. If you don't write answers on your own, you will never know if you're capable enough or not. Please do write answers. Okay. So with the assumption, with the consideration that you will be writing the part one's discussion part by yourself, I'll just skip to the C part. And these are the last 5 marks in order to secure the whole 30 marks. Okay. So it says that using exhibit number 3, we'll only focus on exhibit number 3. Discuss the potential impact of the changes in government regulation on the accounting treatment of Nomstra company in the consolidated financial statements for the year ended 31st December 20x3. So there are some changes in government regulations, and examiner wants you to tell what will be the effect of these government regulation changes on the consolidated financial statements of of the group. Okay. So let us just go and read what are the changes in government regulations. And I would want your support. I'm not going to do this on my own. Okay. So we can just start reading. So guys, it says that near the beginning of the following year, the year ended 31st December 20x3. What do you mean by near the beginning of the following year? It's the start of the next year. Yeah. So at the start of the next year, changes were made to government regulations in the country in which Nomstra is located. So what basically they are trying to say is that Nomstra company in the country in which they are present, there is a change of government regulations. And these must be significant. That is why examiner is asking us a question. This has significantly impacted Nomstra company's operations and caused a fall in the value of NI. So due to the impact of changes in government regulation, this has significantly affected the operations of Nomstra. Examiner says the directors are aware that due to the changes in government regulations, Nomstra company is no longer permitted to transfer funds to Peony company. Now, you see, there has been a change of government regulation, and due to that change, the government has, maybe for a time being, but the government has barred from remitting or repatriating any dividends to your parent company. You see, the point that you need to focus is that if you remember the definition of control under IFRS 10, there were 3 conditions that when they were met, there was existence of control. And the first one was the power to exert control. It was right to or exposures of variable returns and the power to affect returns of other investees, right? So if you focus on this definition, it requires that you can only have control over another entity when you have the right to variable returns and the ability to affect those returns. Now, there has been a government change, there has been a regulation change, and the government for the time being, maybe, they have barred on repatriating any dividends from that country. Does that mean that you have lost control over Nomstra company? I want an answer from you guys and be very specific about it. do you think that we have lost control over Nomstra company? I want an answer from everyone. Do you think we have lost control over Nomstra company? Because at least for the time being, we don't know. The effect of government regulation changes is such that we won't be getting any returns out of Nomstra company. Have we lost control? No, somebody is saying yes and somebody is saying no. You see, you need to understand. Just due to the fact that dividends cannot be repatriated, this fact alone does not preclude, does not mean that you have lost control. Because sometimes this happens. You see, for example, let me give you some examples. Let's say there is a country who is in a situation of war. And if that country is in a situation of war or a severe economic crisis, would they allow their local companies to repatriate their dividends outside their country? I don't think so. You see, war in Russia happened. Would Russians have allowed dividend repatriation of companies to their own principal countries? Maybe, I don't know, but maybe they would have blocked it out. But you see, just the fact that for the time being, your subsidiary cannot repatriate dividends to you does not mean that you have lost control over that entity. Still, you have a right to variable return. I would agree that you cannot get that return in cash right now, but still you have a right to return. You see, it all will depend on if you have the ability, if you still have the ability to direct the relevant activities of the business. If you have the ability still to direct the relevant activities of the business, you would have retained control. Otherwise, you would not have retained control. Make sense? But just the fact that you are no longer, you can get the dividends right now, this alone does not preclude that you have lost control. So you need to read the question further. It says that moreover, government restrictions have been enacted which limit the extent to which Peony company can exercise rights or governance to Nomstra company. Now, what do you guys say? The restrictions that have been enacted by an act of law have limited the extent to which Peony company can actually exercise their role in governance of Nomstra company. Do we have control still? What do you guys say? Have we got control or have we lost it based on the second line that we have read? What do you say? Do we have control? Yes or no? Give me an answer. Do we have control? Yes or no, according to your opinion? Because the law says that you cannot exercise governance over the other entity. What do you mean by you cannot govern the other entity? You have no one on the board. You can have no representation on the board. And that means you cannot govern the other entity. You cannot govern the other entity. Yeah, yeah. You don't have the right over governance of Nomstra company. Governance, those who are charged with governance are the board of directors. As per the recent enactment of the law, you have no governance right over the other entity. Have you lost control? Yes. Because right now, you don't have the power to exert control over the other entity. You see, under IFRS 10, power is defined as the existing capability of, of exercising your control. It is the existing capability to exert your control over the other entity. But right now, at this point of time, you do not have the existing capability to exercise your control. Now, someone might argue, sir, okay, we don't have control since the change of local regulations, but we might have some sort of significant influence. But what they are trying to say is that you don't have any governance role. That means you don't even have the power to participate in the financial and operating policies of an entity, and therefore you may not be able to classify this as an associate as well. Well, surely you have lost control because you cannot go into that country, you cannot exercise governance role in that country, you cannot have a, you do not you cannot exercise your control to get the variable returns out of that company. Sure, you have lost control, but you don't even have the power to participate in the financial and operating policies of the entity because you're not there in governance, you're not there in board. Yeah. So technically you have lost control over the other entity, and if you have lost control over the entity, this transaction should be accounted for as dash. This is a dash type of transaction. Can anybody tell? This is a dash type of transaction. You have investment in another entity. You used to have control over the other entity, but you have lost it. It's not an associate even. So it used to be your subsidiary on which you could exercise your control. And now it is just an investment with no control. Do you see where I'm going? You had control, but now you have no control. You have investment, but you have no control. What type of a transaction is this? You had control, but now you have no control. Yes, this is a disposal. You will have to account for this type of a transaction as a disposal arrangement. Yeah. You see, up till now, most of the times you see examples in which a disposal happens by the way of selling shares. This is a very good question because it teaches you that a disposal in accounting terms does not necessarily happen when you get cash. Sometimes when you lose control over the other entity, there is no more further consolidation of that entity, and you would account for that as a control being lost without even compensation. Yeah. So technically speaking, you will de-recognize all the net assets of S company from your consolidated books. Yeah. And you will debit investment in equity instruments, and that will be carried under IFRS 9. You will remeasure it at fair value at the date of reporting. Make sense? Make sense? So technically, yes, this is a part disposal, you can call it. This is subsidiary to IFRS 9 transition. This should be accounted for accordingly. Now, luckily, your examiner has not asked anything to account for. They are just asking, discuss the potential impact of the changes in government regulations on the accounting treatment. Do you understand this? Do you understand this? All of you, I want your feedback. Do you know, is this clear to everyone? And for this had no relation with foreign subsidiary. This is pure first lecture of consolidation, nothing else. Is this clear to everyone? Yeah. Although it's not mentioned into the exhibit, but if you see, I'm from a practical standpoint, I think that, some sort of nationalization was done in the country of Normstra. You see, you guys do understand what is nationalization, right? Nationalization is when the government takes control over private entities due to any goddamn reason. It may be a scenario of war, or maybe a deliberate strategy of an end of the government or something like that. The government might have taken control over your assets or liabilities without even compensating you for the time being, because there was, there might be any ad hoc reason for it. And that is why you might not be getting your dividends, and you would be unable to sit on the board and something like that. So, although this is not mentioned, I'm just creating a hypothetical scenario, but, from a practical standpoint, this could have been one of the reasons. All right. So guys, like always, I have written a very short answer for you regarding exhibit number 3. This is all what we have discussed. First of all, I tried to explain what is IFRS 10 and what is IAS 28. And then I linked the accounting standard with this case, saying that, the control has been lost because there is no governance role and something like that. And then I tried to explain that why, no power to participation would be there as well, and how would be dealing with it moving forward. We'll be dealing this as a partial disposal of a subsidiary by classifying the residual interest that we have as an equity investment under IFRS 9. Understood? Is this clear to everyone? Let me have your feedback. Finally, the question is over. Khalas, finish, finito. The question is done. Is it clear to everyone? You see, your feedback always encourages me, right or wrong. Obviously, wrong doesn't, I mean, a bad feedback does not encourage me, obviously, but still, do you understand this question? Uh-huh.